very warm welcome to CEO Immersives. This is a series where we bring you in-depth conversations with the creme de la creme of India's C-suite to fetch you pertinent industry insights and, of course, personal anecdotes. Now, today we take a look at the theme of passive investment. This is something that's booming across the globe and taking the investment world by storm. Will India follow in the steps of the West? Well, we're here to find out as Business Today talks to Aashish Somaiyaa, CEO of WhiteOak Capital Management. Take a look.
So thank you, Aashish, for taking out time and speaking to us at Business Today. I will straightway, dive into, today's discussion. Passive funds are gaining popularity in the market, and the share of passive fund, especially, ETFs and the index fund, has gone up to 10%. And I was looking at one report which talks about, 35 to 40% share, in the next 3 to 5 years. Tell us what, according to you, are the main reason, for such a rise in, passive fund.
So I think, multiple reasons for this. I think the prime reason, first of all, whenever there is a discussion on passive funds, the discussion very quickly goes into, whether active funds are beating the index or not, whether they will produce alpha or not, all those kinds of things. If you really ask me, frankly, that's a futile discussion or a futile debate because it stands to reason that if active funds do not beat the benchmark, then eventually, either through their own understanding or through advisors or through media and all the other platforms. The point is that if there is a realization that active funds are not beating the benchmark, then there's nothing to debate. Eventually money will move to passive. So I think the presence or absence of alpha is the last thing to really debate. But beyond that, other than that, I think there are other reasons why passives are finding favor, and maybe they will find favor in future also. The prime reason, according to me, is simplicity. So, today, if you enter if you are a consumer and if you enter the mutual fund industry, sometimes even advisors and intermediaries, or even, as a media professional, you will also agree that it's very difficult to identify, which fund to really pick. Because there are many categories of funds, and within every category, there are many manufacturers who are offering funds in each of these categories. And it's well documented that when you give people too many choices, they end up making suboptimal decisions. And also the stickiness of such decisions isn't very long. So one is, I think, the complexity. On a lighter note, many times I say that to buy some 300 good stocks, we have 3,000 different mutual funds. So that, I think, adds to complexity for people. Today, if you see, a lot of the mutual fund audience is digital first, and a lot of them are do-it-yourself or DIY. A lot of them are, south of 30 years of age, right? 25, 30, 32, 33, that type of average age. So these people, they are DIY, they are digital first. And the least that passive funds can do is to make, simplify how to make these choices. So I think that is one driver, according to me. Second is that if you see, Indians are learning a lot about investing abroad. And, there are not very many managers who have the ability to actively manage. Of course, in India, within our shores, we'll have many active managers who are quite accomplished at doing so. But an Indian investor or Indian AMC looking to put investors' money outside the country, clearly passive is the way to go, because, you're just looking for diversification in terms of the asset classes or the currencies. So, if I'm sitting in India, if I'm investing in India, I might perform active management. But if I'm in India and I have to buy some emerging market or some US or some, other country, then I might just decide that, okay, passive is the way to go, because neither do I have the capacity, nor do I know very many managers who can lend me that capability. So I think these are two things. The place where I disagree with this whole passive debate is because, a lot of our conversation about passives, at least if you follow social media or if you follow the intelligentsia out here, a lot of conversation about passives is influenced from US, because people say that, okay, look, US, active funds are not beating passive funds, active funds are not beating the benchmark, and even our market will become like this. I think there I completely disagree. We are not going the US way. There are reasons why active funds have underperformed in the recent past. I think that is more grounded in the economic performance. I have experienced it that whenever economic performance becomes very narrow, So obviously corporate performance becomes very narrow, and obviously active funds will find it difficult. So that's a different set of things. But I think beyond this active passive debate, the fact is that passive funds can be easy to decide upon, easy to transact. It's less confusing. If you don't know what to buy, you buy the market, and that's how you get started.
Right. Just one question, on this US market. I was just looking at some US data, and there the passive managed funds there in a way have overtaken, the active. So you don't see, such a thing happening here in India in the next, maybe let's say 3 to 5 years down the line.
See, sir, I can tell you one thing on a lighter note, but it's maybe factually true also, that financial services industry is known for very good marketing and very good product, segmentation. And US is the mecca of not just investing. US is also the mecca of marketing financial products. So I think that there is a lot of, when people say that money is moving from active funds to passive funds in the US, I think they are hiding more than what they are revealing, really, if you ask me. If you really see the data of the US and the global asset management industry, which particularly is top heavy and dominated by US, what you will find is it is true that money is moving from active to passive. And as a share of pie, active is losing in favor of passive. But you'll be surprised to know that the bigger movement is the movement from mutual funds into alternative products. Right. So what has happened is a lot of people will try to make you believe that there is no alpha in the US market. I think my data or my learning tells me that the alpha has moved into alternatives, and mutual funds are becoming more and more passive product centric, right? So not to get into a politico-economic debate, but my learning is that the alpha is being sold to the rich people through alternate products like private equity and crossovers and all those kind of things. Whereas the alpha is being sold to the rich people through alternates, and the average investor in the US is being told that, look, there is no alpha, you better buy passives. Because let me just simplify why I am saying this. The biggest growth in US is in the alternate industry, and alternate industry is, all these buyout funds, private equity funds, crossover funds, and the SPACs and all these kinds of things, right? So in US now, a company gets listed. By the time a company gets listed, the market cap is, 75 to $100 billion. Companies get listed 10 to 15 years after they actually started. Till then, they operate in the private market. Till they reach 50 billion, 100 billion market cap, they are funded by private equity investors. So they are the ones who are capturing the alpha. If a company gets listed at $100 billion, where do you think the alpha goes? Right. So bulk of the alpha is moving from public market into private market, and we are being told that there is no alpha. So I think India is nowhere comparable with the US. I'll tell you one shocking statistic. In the last 25 years in the US, the number of listed companies has halved, whereas the market cap has gone up 3x. So it's obvious that public managers, if the number of listed companies becomes half, even as the market cap becomes 3x, it's obvious that the landscape for active managers of listed equity, their landscape is shrinking, and a lot of the opportunity is going in the private market. So I think it's bogus to say that there is no alpha in the US. It's just that the alpha has gone to the private market. We can always keep debating whether that will happen in India or not. Maybe it will happen, but I think it is a couple of decades away, or maybe quite some time away.
Ashish, if I can just ask you one thing, that if you see the last couple of years, couple of trends that we have seen in the capital markets and the mutual fund space is that the emergence of quite a few of these new age fund houses who have very clearly said that they want to go the passive way. That's one side of the picture. The other side is that we have seen the entrance of a lot of first time investors, millennials, the point that you also touched upon, that on the lower side of 30. So do you think a couple of or a combination of these factors has also led to the the movement towards passive funds within the mutual fund space?
I think in India, active funds have struggled for two reasons. One, according to me, is because in 2019-20, our GDP growth was 3.7%. In 2021, it was negative, and in 21-22, it was on a recovery track. But then of course, the market throughout this period of 3 years, the market performance for some or the other reason has been very, very narrow. Economic performance also from 2018-19 till 2021, economic performance was also very, very narrow. So what happens is when GDP growth is anemic or even negative, it's obvious, right, that corporate performance will also be anemic or very, very narrow. So if fewer entities, if fewer economic participants are doing well, that means the index performance will also be very, very narrow, which automatically means that active funds will struggle to beat the index. And this is not just a recent phenomenon. If you go back in 2002, when our economic performance was very, very bad, even at that time, active funds struggled to beat the benchmark. So in India, one of the reasons for active funds to underperform has been the economic performance in the market, in the economy itself. And the second reason could be also, if you really ask me, is that last 3 to 4 years, fund managers and AMCs, I think it behooved them to recalibrate how they invest, because in the last 3 to 4 years in India, the corpus of active mutual funds has probably gone up 2 to 3x. At least 10 years, I know it has gone up by about 4 to 5x. In 10 years, if I tell you, let's say in 2012, active equity funds or the equity mutual fund space was 1.8 lakh crores. Today, it is nearly 20 lakh crores. So you can imagine if you remove ETFs, etc., it has gone up by 8 to 9x. So obviously, if your corpus has gone up 8 to 9x and you want to sustain outperformance, you need to recalibrate your strategies.
So do you think that that era of star fund managers have come to an end, and that has also, played a role in this shift towards passive?
Who the stars are can change. There will always be some or the other stars, at least till the time that we are in the growth phase. Our industry is growing very, very rapidly. New AMCs, new funds, new track records, new types of products being established. So I think that it's just a passing phase, and new stars might emerge at every juncture. I think also the best performing managers, winners rotate, like we say. Best performing managers are also keeping on alternating in the last few years more rapidly. That is also because people are practicing very narrow strategies in a market where actually if you have a broader sustainable strategy, you can have more consistent performance.
And Aashish, in the last 2 years, we have seen this, this fastest fall, the post-COVID outbreak, and also the quickest, way, the bounce back. And I was also looking at some of the FI data, and in the calendar year 2022, almost like FIs have, pulled out almost 2 lakh crore. Okay, again, kind of unprecedented, because last 10 years, I didn't see that kind of outflow. Now, don't you think, it is going to be challenging, for getting returns for active fund managers, or is there a case for passive now for new millennial investor, which Aashish talked about?
No, I think, sir, FPI flows, if you really ask me, they are set to go up. The long trend has been that FPIs have been investing more and more. So a market which has gone 100x, they have been able to raise their holding from 0 to nearly 20%. So I think the long trend is that foreign ownership of Indian companies is rising and is set to rise consistently further. Plus, we are 140 crore people with only $2,000 per capita income. So I think that there also, various sectors and various companies are not even reflected in our market cap. It is set to rise going forward. And the last thing I can tell you is that, when it comes to stock markets or when it comes to corporate sector, I think that returns are made on growth, and returns are made when growth comes at scale. So there are very few countries and very few markets in the world like India, which have scale and which have the growth potential. So my sense is next 10, 20 years, a lot of money is going to be made for investors in India. As a result of that, I think foreign holding and foreign interest in owning Indian companies has been rising, but I think is set to rise far more significantly compared to the past. On your point, maybe I've given a long answer, but all of this will result in more institutionalization of the market. All of this might result in more efficiency in the market. Anyway, our regulations are top-notch. Our market infrastructure is top-notch. Add to that more institutionalization, more efficiency. Yes, I do agree that going forward, it might become difficult for active managers. But I would still wager that it is about, it is few years ahead of us. It is globally the most diverse market, meaning we are the most diverse market in terms of the sectors. And second, we are most diverse because in every sector we have small, mid, and large cap companies. We have more than 7,000 listed companies and it is only rising. So we have 2x the number of listed companies compared to US, and it's only rising. So our market construct, our economic potential, all of these things suggest that there is huge potential for alpha in India. And we are not going the US way. If at all, there is still a long way to go.
So you talk about the market construct and the growth, stocks and all. So does it make sense to invest in a, say, let's say index which tracks, a small cap or mid cap? I'm sure, the performance there will reflect in the indices.
Three areas where one can look at passive. One, I already mentioned that if you don't get a good manager, then international investing, maybe you can go passive. The second is the large cap space, because our regulation is very tightly defined that the top 100 companies is large cap, and they are becoming bigger and bigger companies which are widely covered and widely held. Efficiency is very high in the large cap space. So one is large cap, where I can think that you could possibly go passive. Second is international funds, where I think you could go passive. And third is, if you are someone who is basically in the mindset that I'm just doing my asset allocation, I want to just buy equity as an asset class, and then I don't want to go into choosing stocks and choosing fund managers and evaluating or monitoring their performance, etc., etc. I just want to buy equity as an asset class. Then I would say just buy BSE 500, a Nifty 500 index fund. You bought the whole market. When you are saying about small cap and mid cap, I would beg to differ, because if you leave aside the top 100 companies, the next 150 companies are mid cap. If you leave aside those total 250, everything else is small and micro cap. So there is a lot of potential to generate outperformance there.
And you talked about the asset allocation. So what percentage of shares, suppose, one should put in passive? Because
somebody is just doing asset allocation and doesn't care for making choices of funds and stocks, and they are okay with the average return of the market, I think they can just go for Nifty 500. That's just one thing to buy. But on the other hand, if somebody is going the nuanced way, which I'm saying, that you do believe that because, and I genuinely believe that in small and mid cap, there is alpha to be made, which automatically means that if I'm managing multi-cap, flexi-cap, large and mid-cap, small cap, then in all these spaces, I can make a claim that, we can generate alpha.
So do you think when it comes to these kind of innovative themes, if we can call it, passive as of now holds an edge over active schemes?
When an asset management company creates products for like 5, 10, 15, 20 different themes and sectors, they are basically just, everybody in our childhood, we played with Lego blocks. So what is happening is that people are just creating all these Lego blocks, supplying Lego blocks with the tacit understanding that you will use those Lego blocks to make your own house or your own factory or your own whatever you want to make, right? So these thematics and sectoral indices are to be used as Lego blocks to construct something.
When we talk about a mix of active and passive,
it's not about or, it is always about and. So as you would have got a drift from my conversation that I'm not on one side or the other. I'm just trying to clarify that there are use cases for everything. You just have to sit back and think whether it's relevant for you or not. So I think you mentioned sectoral and thematic indices. Then we discussed international indices. We discussed Nifty 500. We discussed large cap. Of course, we discussed alternates. We discussed active, small and mid cap and multi cap and all. There is use case for everything. Clearly, they all are meant to play a particular role, right? And I think you should know what you are using for what purpose. That's the key point.
And Aashish, one last question is on the tracking error or the tracking differences in terms of return. How do we fare in India vis-a-vis US or other markets in terms of tracking the returns?
No, I think, it's a function of multiple things. I think US would be way more efficient. I have no doubt about it. I think passives are evolving here. I think the execution, the market infrastructure, the efficiency, the liquidity of stocks, there are multiple issues, and I don't think we are right up there. I think when it comes to tracking error or the fineness of pricing or the fineness of tracking the index, I'm quite sure that countries like US are ahead of us, and I think it will take us some more time. It's a question of how well the asset management company executes, how well the market making is functioning, how well the efficiency, liquidity. So multiple factors. I think we have some way to go on that.
And one last question, Aashish, stock market, is a very demanding, profession. It starts with Singapore and Hong Kong in the morning, then India, and then the US in the developed market. I just want to know, how do you relax, or how do you switch off? Because it's all 24 hours.
Yeah, so I think it is. My sense is that it can be very demanding and very taxing, depending on how you operate. So, for example, most people like us, are like, say, WhiteOak, for example. We all are fundamental investors, right? So, meaning that we have our investment universe, we have our criteria of how we will build our portfolio. We are very clear that we are running for relative return to beat BSE 500 consistently. So we know what we are looking for, and then we have to filter out the noise, that what is not relevant. Like, for example, so I think a lot of that is just noise. Tracking too much macro, tracking too much politics, tracking too much of international markets. Ultimately, it can be noise. I think we have to focus on what is relevant for us. If you ask me what is taxing about my job, for example, I think because it's investors' money we are managing, and it's very well documented that the return that the investor gets is not just the function of how well we do. It's also a function of how well we communicate and hold hands with investors. Last few years, 2 or 3 times the Nobel Prize in economics has gone to people who study investor behavior rather than to people who study supply, demand, interest rate, and exchange rate. There is a reason for that, because investor behavior plays a big role. So I think performing in a way, communicating in a way which is supportive of investors' cause. I think that is the challenging part. Managing money is not the only challenging part for AMCs, according to me.
So any tips, for these new investors, or investors, who are not your investors today, on how not to lose, in the current, volatile markets?
Yeah, I think when Aashish asked, that was an insightful question, which is basically that, not to get carried away with, every product that comes in the market is not for you, is not necessarily relevant for you. Every theme, every trend which comes is not necessarily aimed at you. It's not relevant for you. So, knowing what you are investing for, knowing what your goals are, knowing why you are investing and what outcomes you are expecting. I think those things are far more important than what types of products are available in the market.
Right. And thanks, Aashish, and it's always a pleasure, talking to you. Thanks a lot, Aashish.
Thanks, Aashish.
Thank you, sir. Thank you for having me. Thank you, Aashish. Thank you.
If you like the video, do like, comment, share and subscribe.